Hello, everyone. My name is Bruce Fry. Today, I'm going to walk you through a full market analysis of soybeans. We will look at where soybeans are grown, what people use them for, what makes supply and demand move, how prices are discovered, the path from the farm to the end user, and the main policy tools farmers use. Let's get started. The agenda. Here's a quick roadmap of what we will cover today. First, I will introduce the soybean crop itself, where it is grown and what it is used for. Second, we will look at supply and demand, and I will show you a graph. Third, we will talk about how prices are actually discovered in the market. So, fourth, we will follow the marketing channel from the farmer all the way to the consumer. Fifth, we will touch on policy, risk management, and futures markets. And finally, I will wrap up with conclusions and recommendations. The production regions. So, soybeans are truly a global crop. Right now, Brazil is the world's largest producer. They grow roughly 42 to 45% of all the soybeans in the world. The United States is second, producing about 27 to 30%. Argentina is also a major player, especially when it comes to soybean meal and oil. China grows some soybeans of its own, but it imports far more than it produces. In fact, China is the single biggest buyer of soybeans on the planet. US regions and major uses. Here in the United States, the big soybean states are Illinois, Iowa, Minnesota, Indiana, Nebraska, and Missouri. Most of the crop does not stay as whole beans. About 70 to 80% gets crushed into two main products. The first is soybean meal, which is the number one protein source for livestock feed, especially for poultry, hogs, and cattle. The second is soybean oil, which is used for cooking oil and more for renewable diesel and biodiesel. A smaller share goes into human food products like tofu, soy milk, and edamame. The historical significance and current trends. Soybeans originally came from Asia thousands of years ago. The United States became a major producer during the 20th century. In recent years, Brazil has taken the lead in total production volume. So, one of the biggest stories in the market right now is Chinese demand. China still buys the majority of the soybeans that move in world trade. Another growing source of demand is renewable diesel, which uses a lot of soybean oil. Prices cooled off after the big highs we saw in 2021 and 2022, but weather and trade news still cause large price swings. The supply determinants what actually decides how many soybeans farmers plant each year. Weather is the biggest short term factor. A drought or perfect growing conditions in Brazil or the Midwest can change the global supply by millions of tons, almost overnight. Input costs matter too. If fertilizer, seed, or fuel get expensive, some farmers plant fewer acres. Technology helps farmers grow more on the same land to better seeds and precision tools. Expected prices at planting time are also important. If the futures market looks strong, farmers often shift acres from corn into soybeans. Government programs and the relative profitability of competing crops also play a role. The demand determinants on the demand side, China is the giant. Any change in Chinese livestock feeding or import policy moves the entire world market. Biofuel policies that favor renewable diesel have also increased demand for soybean oil. As incomes rise in developing countries, people tend to eat more meat, and that raises demand for protein rich soybean meal. Other protein meals and other vegetable oils can act as substitutes when soybean prices get too high. The strength of the US dollar matters as well. A strong dollar makes American soybeans more expensive for foreign buyers. And of course, tariffs and trade agreements can open or close markets very quickly. The supply and demand graph. This graph shows how the soybean market works in simple terms. The upward sloping green line is supply. Farmers produce more when the price is higher. The downward sloping red line is demand. Buyers want more when the price is lower. When China buys more soybeans, the demand curve shifts to the right, and both price and quantity go up. When Brazil has a huge harvest, the supply curve shifts to the right and prices fall. So when the United States has weather problems, the supply curve shifts to the left and prices rise. But these three forces, China, Brazil, and US weather, are the main drivers of soybean price swings from year to year. The price determination and market behavior. Most soybean prices start with the futures market in Chicago. Buyers and sellers of futures contracts agree on prices for future delivery, and those prices become the main signal for the whole industry. Local elevators then offer a cash price that is usually a few cents under the futures price. That difference is called the basis, and it reflects local supply, local demand, and transportation costs. Processors also watch the crush margin, the value of the meal and oil they get versus the cost of the beans they buy. Prices tend to be weaker at harvest in the fall when new crop supply hits the market, and stronger later in the marketing year when supplies tighten. The marketing channels, let's follow a load of soybeans from the farm to the end user. First, the farmer grows and harvests the beans. Next, a local elevator or cooperative buys them, stores them, and loads them onto trucks or rail cars. Then a large processor crushes the beans into meal and oil. From there, the products go to exporters, domestic feed mills, food companies, or biodiesel plants. The path is fairly straightforward, but each step adds value and cost, and the big processors and traders handle a large share of the volume, the market structure. At the farm level, the soybean market is highly competitive. There are thousands of independent farmers selling a nearly identical product, so no single farmer can influence the market price. Cooperatives help farmers gain a little more bargaining power and share marketing costs. Downstream, the picture is very different. Processing and global trading are much more concentrated. A small group of large companies, often called the ABCD traders, handle a big share of the crushing, exporting, and worldwide trading. This concentration gives them significant influence over margins and logistics, policy, risk, and futures markets. Farmers have several tools to manage risk. The Farm Bill programs, price loss coverage, and agriculture risk coverage help protect income when prices or revenues fall. Crop insurance is also widely used. Trade policy, especially relations with China, can change export demand very quickly. As we saw during the trade tensions a few years ago, biofuel mandates continue to support demand for soybean oil. And many farmers and elevators use Chicago futures and options contracts to lock in prices ahead of time. This is called hedging, and it reduces the risk of a big price drop between planting and sale. My conclusions and recommendations. To sum up, the main forces driving the soybean market are weather in South America and the Midwest, Chinese demand, biofuel policy, and the strength of the US dollar. Farm level markets are competitive, while processing and trading are more concentrated. My recommendations are practical. Producers should use futures or marketing contracts to manage price risk and should watch basis levels carefully. Marketers should build strong relationships with elevators and processors and understand local transportation costs. Policymakers should aim for a predictable trade environment and continue supporting risk management tools that help farmers stay in business through the price cycles. The future outlook, looking ahead, long-term demand for soybeans should stay firm. Growing global protein needs and continued use of soybean oil and renewable diesel will support the market. Brazil is likely to remain the top producer and a strong competitor for export business. Prices will keep swinging from year to year because of weather and policy changes. US growers who adopt better genetics and precision farming tools will be in the best position to stay competitive on both cost and yield references. So the information in this presentation comes from USDA reports, the American Soybean Association, FarmDoc Daily from the University of Illinois, Chicago Board of Trade data, and materials from our Agriculture Business 2100 course. Thank you for listening. I am happy to take any questions.